Welcome to the midweek market update where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. I've also got some ideas on the Coinbase IPO and 4 trade ideas at the end of the video, so stay tuned. So kicking off the S&P analysis with our sectors as always, who is leading, who is losing, and where is the weight? XLE energy sector led the pack today, up about 2.78%. Tech sector, the heaviest weighted sector, down about 1.06. And obviously, when you see a red tech sector, it's no surprise that your S&Ps are going to be red and your Qs are going to be red as well. In terms of the next heaviest weight, the XLF, the financials, only being up about 0.6% was not enough to sort of lift the S&P up as a whole, as well as the third heaviest weight, the XLV for healthcare, essentially flat, right? So that wasn't helping the case for an up day across the market either. But if we think about where risk is across the sectors, I would say that no one sector is at more risk than another. Basically, as many of them lie, they could all use a little bit of a pullback. And that's in air quotes there because we know that markets don't have to do anything. They don't have to pull back. They don't have to be extended or not. But visually, they definitely could use a little bit of a pullback, right? So in the XLK, if it does continue to pull back, obviously a red day here, the area you want to see hold as support is 138.61. Not only is it the gap fill here, it's also a prior market high in there. So you would want to see that prior structure act as support. Maybe we consolidate into a daily bull flag like this, and it would set up a move higher. So even if XLK pulls back, not really at any more risk than something like XLF, the financials for pulling back. This one's been in a very controlled uptrend, move up, pull back, move up, pull back, move up, and most importantly, new high here, right? We actually set a new high, a higher high, instead of doing something like leg up, pull back, lower high. This right here, when you set that lower high, that's where you start to get cautiously bearish. That's in quotes there, cautiously bearish, and that just hasn't happened yet. So there's no reason to start to think that the market's going to crumble. Again, could a little healthy pullback form here? Absolutely. We'll form a higher low and then move on from there. So both of them, even if they pull back, one versus the other is not at more risk of causing any damage to the S&Ps overall. Same thing with the XLV, right? We had an inverted head and shoulders. It played out nicely. We got a break of the neckline here, went to the all-time high target essentially there. And even if we pull back, again, do something like this, that's just going to be a potential higher low. So until we form a lower high, first of all, do something like this, pull back, and then set a lower high again somewhere in here, same thing applies. It doesn't really scream start thinking bearish quite yet here across any of the market sectors that we want to pay attention to into the end of the week. The VIX is something I also want to point out here. It is at a yearly low, essentially, and the only time I would start to really get worried, per se, about a market crash incoming or something like that would be if the VIX got elevated above the 20.5 handle, and it's just not even close at this point in time. Now, don't discount the fact that, some sell-side activity certainly can cause spikes in the VIX, but as it sits right now, again, not really getting overly concerned for a major market crash until we hit that 2050 area on the VIX. And again, let's just go back to the SPY chart here. Does it look like it could use a little bit of a healthy pullback to you? I mean, to me, it certainly does. And again, that's in quotes there. It doesn't have to pull back. It could consolidate sideways through time. But how the chart sits right now, I wouldn't mind a little bit of a pullback, right? It might provide a little bit of a buying opportunity. The rest of the video is sort of going to be themed about who's in control of this marketplace. Because if we can understand who's making the calls, essentially, we can understand and make better trading decisions ourselves. So I would argue, look at how nuanced these levels are, right? Very, very tight. That, to me, is telling me that short-term traders are in control of this market. And we'll look at some more things that prove this theory. But for now, in terms of SPY levels to pay attention to, if this pullback continues, this is first up as support at 410.50. If it breaks, a little room to run lower, right? About $3.50 lower to about 407. Prior area of resistance acted as support here. Again, if we get there, want to see it act as a first touch support, but anything underneath, it's that all eyes on level from the weekly watch list on Sunday at 405.38, because as we know, poor structure here, that'll just give way to the gap filling. And again, even if we pull back and fill the gap, that would be completely fine, in my opinion, for a healthy pullback. Look at how far we've come. It would be completely fine to, again, pull back in a controlled manner. I'm not saying do something like this, spiral out of control over the course of 2 or 3 days, but a controlled pullback would be fine and merited at this point in time in the S&Ps. In terms of, again, the internals, this supports the theory that, once again, short-term traders are in control. So if you're not familiar with this screen, get familiar. Top right-hand corner, it'll show you what this all means and how you can set it up. Volume read here, extremely weak the entire week. Look at this. Down day, even though we had a green day in the S&Ps, flat on Tuesday, and today it looks like a nice strong read to the upside, but keep in mind, just barely got to 200 million, and we don't really start putting too much weight into the actual read here until we start taking out those 300 million areas. Look here. That's where we start to say, okay, this is something to the downside underneath 300 million. Okay, this is something. Looking back even further, again, this is something over that 300 million. And today we just barely cracked, again, to the 200 million. Look at how flat it was prior to that. So I think short-term traders not committing a whole lot of volume, just little trades here and there. It's not like institutions are really buying at these highs. Same thing holds true for the advanced decliners. Even though we had an up day there, look at this, just no correlation at all. It's not like people were buying the market as a whole. It's not like long-term institutions were just buying the market, positioning for a future move higher. Same thing here on Tuesday. It looked like we may have gotten a little bit of correlation today, but ultimately given back into the end of the day. If the larger term, longer term players were in this market, you would see the ADD hanging out up here, maybe all the way up in trend zone, or let me just clear that up, do something like this, lower left to upper right, trending higher all day as they accumulated across the market. And that just wasn't the case today, or essentially the entire week. And lastly, the dead giveaway. This one is so obvious in my opinion, is the tick down here in the bottom left. Look at how controlled it was the entire week, right? This is people just grinding the market higher. They're comfortable in their longs. The market's just chugging along. Everything's fine and dandy. As soon as we start to see any little bit of selling, boom, panic sets in. People are slamming the button, sell at the market. It doesn't matter. Get me out of the long position. It looks like we could be selling here. That's not what a longer term trader or investor would do, right? This is not how an institution sells, by panicking out of positions. If an institution is going to sell, you're just going to see a controlled day, but underneath the zero line. Maybe it dips down, sets a low, something like that. You're not going to see out of the blue these really emotional tick readings. So again, short-term traders here appear to be in control of this marketplace. One last thing that sort of proves this before we get into the market profile is if we look at the VWAP, right? The VWAP is your volume-weighted average price. That's what institutions use to mark as a fair deal. So as we sell away from it, okay, fine, we had a leg down. Where would your institution sell next? Well, they would wait for prices to get back to VWAP or fair value, and then they would sell it from here, something like that. You see what I'm saying? They would wait until it gets to the VWAP. That way they're getting their customers, essentially people who are invested with them, the best deal that they could on that day. Institutions do not do something like this. Slam it lower. Don't even wait for a retrace to VWAP, slam it lower again, emotionally just selling and selling like that. That's not how they work. They need to work more controlled, more methodically. So again, short-term traders remain in control. But what do we do about this information? Let's go ahead and check out the market profile. I think this will help in terms of understanding, how we can treat some of these levels. So when short-term traders are in control, we need to treat short-term reference points as weak, because these are traders that are looking to make a quick trade and not necessarily hold this and, defend their area of entry, or even add if it goes lower, right? So on today's profile, poor low. Basically what happened is shorts got too short, too fast. We moved away. They were forced to cover. But if we're forced to revisit this area, short-term buyers likely have stop losses underneath today's low. If it breaks, again, maybe we get some sort of liquidation where longs panic out of their positions. How else do we know that we are seeing short-term traders in control from the profile? Well, here we go. Let me show you this. Here is what we would consider a spike, a late day rally. Sure, there's more than one TPO up here, but if we split this profile up, look at what happened. We hold it on the open, right? We don't go any lower than essentially this spike. And as the selling starts, it's only after we break that do we see liquidation much lower. So I and J period, boom, that's where we break a visual reference point and go lower. How else do we know that short-term traders are in control? Let's remove that. You can see here, where does this open and, where's the low of the day? Right at the point of control. Do you really think that a large, hedge fund manager, large institution is looking at the point of control on the ES from the prior day? Probably not. Same thing happens here, right? Look at this spike. Look at where the low of the day is, right to the top of the bottom of the spike. That's a short-term reference point. If we were to revisit this area, I would suspect that we trade lower and probably go, if we remember back to those 3-day highs, there's your 3-day highs. That's the area of support that you want to watch. Again, short-term reference point. Who bought the pullback to those 3-day highs? Probably the short-term trader. And then underneath that, why did we say that there's poor structure underneath? Look, poor low, spike. This should be moved through with ease. And remember, there's a gap underneath this, okay? So very poor structure underneath. And if any of these reference points start to break, again, treat them as weak, likely to see follow through underneath. Now, although I've spent a lot of time pointing out the reference points underneath us, the market can move higher, right? I'm not saying that the market has to roll over here. I just want you to be aware of all of the little nuances below us that sort of prove the point that short-term traders are in control as we sort of sit right now. And those are some areas on the charts that I would want you or encourage you to be paying attention to for a potential trade to develop. Okay, so with that being said, let's move on and wrap up the broad market here with the Qs. We'll move back over to this chart here, and we'll zoom in a bit with our tool. This is fine. Basically the same thing, right? We started to see a little bit of a pullback. We filled this gap. If we move lower, the key areas on this chart, 3-day highs at 332.63, poor structure underneath that 329.50. Expect this gap to fill all the way down to 324.73 if there is any major liquidation that sort of comes out of nowhere. To the upside, if we break over 341.08, just treat it as blue sky levels, whole and half dollars, intraday levels that do form. But again, short-term traders in control. Any visual reference point should be treated as weak. If it breaks, go with the break, look for slightly lower. That would be confirmed by internals, right? Something like our tick doing this again, slamming negative at, minus 1,000 or even greater or lower, minus 1,000, okay? That's the Qs. IWM, same sort, well, not quite the same, right? IWM actually tried to make a high here, make a run for it. Didn't hold it. It is holding the 50 SMA. It's around chop zone. I would be very careful with IWM and just treat it as a market indicator. We filled this gap and moved higher away from it. If it were to be revisited, I would treat it again as a weak reference point. Think of all the stop losses that are underneath. If those get, triggered and you get a little stop run, probably down to 215.03 in IWM, especially with this upper wick signaling that sellers did come in to sort of join the party there with the rest of the market. If we go higher, I would avoid longs until we clearly accept over 227.09 for some, upside targets here. 220, let's call it 230 there, and obviously all-time high after that. But again, using IWM as more of a benchmark as opposed to an actual trading vehicle. Let's get into the Coinbase IPO, okay? This one's interesting because there's a few things I want to point out here. First one is that you need to know who you are. Are you an investor or are you a trader? That's the first question you need to ask. If you bought this today expecting to trade it very quickly, maybe you bought 410 and you wanted to sell at 450, right? And you didn't get that, probably bail on the trade, right? You may have to turn into an investor here if that was your plan and now you're too stubborn to sell at a massive loss. And again, just know who you are. Are you a trader or are you an investor? If you're a trader, then you want to pay attention to these levels. The opening print here, which was around 380.59, and the high of the run-up at 229.54. If any of those areas are revisited, if we do something like this, and keep in mind, this is a 5-minute chart. It's all the price data we have to look at. But if this is revisited, we get some consolidation below. That's a buy on the break back above that 380.59. If we do this again, bull flag right underneath the high there, it's a buy on the break of that 429.50 into essentially blue sky territories here in coin. Okay, I'm not saying that has to happen this week, but those would be the levels to pay attention to. As it moves lower, there's not any shares to short. There are no options on it yet. So just stay away until it comes up and potentially sets up underneath some of these critical levels that we just talked about. Again, most important question that you have to answer first is, are you an investor? In which case it probably doesn't matter where you bought. You're probably going to hold this for 5 to 10 years, expecting it to be much higher than 430 in that time frame. If you're a trader though, put your thinking cap on. Do you really want to hold it for potentially as long as it takes for this to get back to profitable if your original plan was only to trade it for about 5, 10, 15, even 30 minutes, right? So keep that in mind. Next up, into the 4 trade ideas. First one is on AMAT for applied materials. We're going to want to go back out to let's go with a 1 year, 360 days, and wow, daily. There we go. 1 year, 1 day. That's what we want right there. And basically the idea here is if the market continues to pull back, where's a buy point in applied materials? It's quite clearly here, right? Very long-term support trend line intact, prior area of market highs. If we go here, I'm going to start looking out for a buy, whether or not it's a day trade first touch bounce or something you want to add to a longer term portfolio. I would say around 125 is a good buy here in Applied Materials, AMAT. Next up is AMBA for umbrella. And this one is, what was I thinking on this one? This one is a head and shoulders pattern, right? So what we have, shoulder one, head, shoulder two potentially forming. The reason I like this one is the inverted hammer here. If we were to revisit this area on the chart, if we grab the other tool for a moment, if we were to revisit here at 93.61, I'd be looking for the flush, right? Probably down to the 200 SMA. Maybe you get a little bit of a bounce here as an obstruction at 85 just about, but that's a longer term setup here in AMBA, and only if the sort of market rolls over, right? Like we talked about, if some of those short-term references start breaking, maybe this is something that you want to watch out for a short. Next up is Target, and this one is the opposite, right? This is going to be a bullish setup. This is one of my favorite stocks to hold long-term, that is, and it's setting up for a potential day trade entry over our sort of pressure cooker top area here at 206 the whole dollar. Look at the resilience that this thing has shown. As the market's moved higher, it's done it in a controlled manner. It's made a leg up. It's consolidated a number of days. It's made a leg up. Now it's consolidated in a number of days. If it goes over 206, we're just looking for blue sky levels, whole and half dollars, intraday levels that do form. You don't really want to, or at least I would avoid the short underneath 203.16. I would just avoid this short in general. But if you're dead set on it, you take the break probably of that area there. You don't really get much. You can see that your next area of support would only be down to about 201.13. I don't really think the risk reward is there on target to the downside, which is why we're keeping it a bullish setup here in the video. And then we'll go to WDC for Western Digital. These guys make great storage devices. I actually own one and I'm looking at one right now, 1 terabyte hard drive. For now though, WDC, what do we have here? I would be looking for this gap to potentially fill and it to be a buy on the gap fill, right? So as tech, if it does continue to pull back, this may get a little bit, more red activity on it. And pre-earnings, if we come down, fill the gap, touch the 50 SMA, I'd be looking for a first touch bounce. That's a very quick intraday trade. You essentially don't want to fight this overall rollover that's happening here. But if it were going to bounce, if the market perks up a little bit, that's a buy point here in Western Digital. Again, very quick, right or right out. If you buy it here, your stop loss is obviously just below the gap fill, okay? So very limited risk for the potential of a dead cat bounce after a few days of selling. And again, that's WDC, and that's going to be the 4 trade ideas into the end of the week. Keep in mind earnings on this and earnings across some of our companies as the month goes on. If you enjoyed the video or learned anything new, feel free to let me know down below in the comments section. I wish you all a green trading week, and I hope to see you in the weekly watch list on Sunday.